All right, welcome everybody. Happy Wednesday. Hope you're all having a lovely morning or afternoon or evening, wherever you may be joining us from today. I'm super excited to have you join our Power Hour series. This month, we are hosting a Build Your Business series where we are diving deep into the strategies and resources that will help you take your brand to the next level. For those of you who don't know me, I'm Megan Sokol. I'm the marketing director here at FounderMade. And I'm very excited to introduce you to our expert panel today. Today's Power Hour is called Capitalizing on Capital Raises. We'll be talking all about what you need to know leading up to your capital raise, all the way through deploying that capital. And it is presented by Paro. I'm very excited to introduce you to John Rutka, who is the VP of Growth at Paro. John, I will let you take it away.
Thanks so much, Megan. I know we're all excited to be here. We've been looking forward to this for some time. Real quick to kick us off, Paro is certainly not the focus for this afternoon, but as a little bit of background, Paro is a marketplace purely dedicated to the finance and accounting sector. And what we found is there is a massive opportunity to disrupt the legacy way that finance and accounting services were delivered, namely to provide small businesses, startups, high growth companies with access to expertise that previously they were restricted to either hire someone in-house or lean on an expensive, unspecialized firm. We take a completely different approach where we match businesses, much like many of you, directly with the turnkey solution providers that are exactly what you need, whether that be transactional accounting, high-level CFO, fundraising advisory, technology implementation, or really anything in between. But really want to get on to the meat of our value today, which is, as Megan mentioned, capitalizing on capital raises. To make sure that we have as structured and as actionable of a session as possible, we have one quick poll that we want to run up front, really oriented around what sort of capital raises this group is most interested in hearing about today. And so if you wouldn't mind responding to this over the next couple of minutes, I want to turn it over to our esteemed panelists. Give them a chance to do a quick introduction with one prompt besides just your background and a high-level overview. Why are you passionate about the topic of capital raising? Jeff Briggs, if you don't mind, why don't we start with you?
Sure. So hi, I'm Jeff Briggs. I kind of come at this from a bit of a non-traditional background in regards to finance and accounting. So I didn't come up through an accounting firm and stuff like that. I actually started out as a systems engineer for NASA, knowing I wanted to get into the business of, high-tech things. Became a project manager with them, got my MBA while I was there, and then ventured out into private businesses a little over a decade ago. Got into the finance space, working with a private family office in Cleveland, Ohio, that invests in operating companies as well as private equity and venture capital type investments. And through that, probably about 8 years ago, started organically working with both the boards of companies, investors in companies, and then eventually founders of some of the companies I met. Sort of as a freelance CFO type person, going back 8 years or so. Started with Paro, a couple of years prior to now. And one of the things I like about doing this is that, you get to interact with a very, very broad array of different kinds of companies, different situations. Everything is pretty unique. This is totally off topic. I just noticed that my name is backwards on the banner up top. So if you can't read that, that's okay. Yeah, it's a different challenge every time. I like helping people figure out their own personal situation. Sometimes the outcome is that you actually don't need to raise capital. So some of those have been as successful as some of the successful capital raises I've done. And yeah, I just like the variety of it all.
Appreciate that background. Certainly a really interesting approach to get into finance. That I've seen in practice serve you exceedingly well in terms of our clients. A little bit of a different perspective. Jeff Fiddleman, mind provide an intro, and again, same prompt. Why are you passionate about raising capital?
Yes. Thank you for hosting this event. My name is Jeffrey Fiddleman. I guess background first. So I have also an eclectic background. I guess that's maybe a thing of all Jeffries. I started out actually in real estate, and I built my own brokerage back in 2007, 2008, taking advantage of what was happening in New York. We represented buyers only. And as that business grew, I was able to ultimately sell it to my partners and spend the next 5 years in banking. I spent half of that at Morgan Stanley and the other half at HSBC, where I ran strategy and revenue for all of Manhattan. And while at the bank, I was recruited by a family office to help them set a venture capital fund up, where I was a partner. Our thesis was early stage tech-enabled investments, where we provide them with seed capital and then go on to help them grow into their Series A. In 2015, that first fund was allocated, and the family decided to go into portfolio management mode and ultimately reinvest proceeds. So I left and began consulting. So I've been consulting since 2015. I now run a firm with just under 40 consultants. All of us are US based, but all remote. And our focus is on strategy, specifically fundraising, go-to-market, and growth strategy for early to mid-stage businesses. Why I'm passionate about fundraising and specifically what I do in fundraising strategy is because I've sat on both sides of the table, both as an investor and as an entrepreneur seeking to raise capital. So I think that I bring a unique approach from working with a lot of the businesses in that I've seen a lot of these deals get done. So I think, or I'd like to think I know what people are looking for when they're sitting on the investment side. But at the same time, I know the difficulties that an entrepreneur goes through in running their business and trying to raise capital, which is in and of itself a full-time job. So I'll piggyback off of what Jeff Briggs said. I find it valuable that I can add that value to all of our clients.
I would argue invaluable expertise on both sides of that table, something that we've all been excited to share with the broader Founder Made family. Before we really lean into it, one more panelist, a colleague that I feel blessed to have worked with for the last 5 years now, Dan Wyrott. You mind giving a quick intro and sharing why you're passionate about fundraising?
Thanks, John. Super excited to be here today and on the panel with the two Jeffs, and excited to dive into all of our questions. So different name, different background, more traditional and what the Jeffs kind of said they strayed away from. But my kind of pre and mid grad years, I spent several years working with the founders of a legal process outsourcing business to try and get that off the ground. Fantastic opportunity, and really showed me how ripe for disruption the professional services world is when a guy in a college room could be help kind of pushing a company into it. Incredible experience. Post grad, I got into KPMG. I was doing financial due diligence, FDD there, primarily for private equity buyers, some private equity sellers as well. And then I ended up leaving that to help run the finance function at a startup incubator. Fast forward a couple months, rather than supporting all the portfolio companies, ended up launching a portfolio company myself out of the incubator, Paro. Here we are today, about 6 years later. In the early days, very hands-on with all of our clients when we were proving the concept of Paro in the marketplace. Got to see so many different small businesses, both in the venture capital-backed space, the debt capital raise space, and people that were just building lifestyle businesses and they wanted nothing to do with capital. I'm super passionate about today's topic because I've been living in it while simultaneously learning about it, as Paro's been fortunate enough to go through several successful rounds of VC funding, angel funding, as well as positioned us for some venture debt term sheets through the years. We're just in this incredible space. We're disrupting an antiquated space that I came from, while even using the own platform we created to help us do it at the same time.
Appreciate all the information. And while I do fully appreciate it, I'm just the window dressing here and going to be facilitating the conversation. Remiss without mentioning, highly passionate about the topic as well. I've sat in the room, helped Paro actually successfully raise our last 2 rounds, our Series A and Series B, as well as having directly supported dozens of clients through their own private equity, venture capital, family office, et cetera, fundraisers myself on the Paro side of things. Before we really dig in, just last 2 comments. We have an open Q&A via chat. Thank you to about a dozen of you for already submitting questions ahead of time. We'll be sure to carve out some time at the end. But if anything comes up in real time, please do use that chat functionality, and happy to prioritize those live questions over anything that we had prepared to discuss. And number two, Megan, do we have the results of that poll that we can kind of flash on the screen? All right, so I think the group has spoken. We'll have a pretty even weighting between the more private friends and family and early stage angel crowd, as well as some later stage VC. Not to say that we will completely ignore private equity debt factoring and some of the other vehicles out there, but appreciate that this context really helps us make this actionable for you all. So enough intros, let's lean in. Question number one, and why don't we start with Jeff Fiddleman here. How do you help your clients start to understand when is the right time for them to raise capital?
When is the right time for them to raise capital? Well, good question. And I know in some of the prep meetings, we promised one another never to say it depends. So I'll stay away from that as much as possible. For different stages of companies, there are different requirements of capital. And maybe the best way to answer this question, when is it the right time to raise capital, is based on when investors would be most inclined to provide capital to companies. So maybe I'll start kind of at the bottom. Early stage, you have an idea on a napkin and need to build something. To the extent that you have any capacity, and when I say you, I'm using the entrepreneur in this case, whether it's a group of founders or a single solopreneur, getting that product as much or as close to a proof of concept as possible without taking in outside capital would be the ideal goal. However, I'm sensitive to the fact that that's not always a possibility. So that would be the round, or that would be the time to go out to friends and family to raise some capital and get that started. Whether it's bringing a product to market, or rather bringing a beta to market, proof of concept, just having a user go through a full transaction, whatever service or product that you're actually looking to share. That would be the initial funding piece that you would need to get from, let's call it idea on a napkin, to I have now a proof of concept. I can put something in front of an investor. A user, whether it was of a service or a product, has had their hands on my wares and can give me feedback on it. At that point in time, you probably need to raise additional capital. And for that, we'll call it commercialization. So once you have proof of concept, once you have someone who has used this, whether or not you've achieved funding to that point, that's kind of the next lever, in my opinion, of when a company should go out to raise additional capital. And in each of these stages, it's important to understand that there's always a list of risks. And when you're starting out with that idea on a napkin, it could be a list of 1,000. And the further you get along in the process of your company or the progress of your company, that list is shortened and more likely to attract investors. So as you have a proof of concept, as you're able to go out into the market, now you need additional capital to commercialize whatever it is that you have to do. If it's technology, perhaps it's development and product costs. If it's a consumer good, maybe it's machining or tooling costs to manufacture or warehouse. So that would be the next point of really raising your first real round of capital, whether it's pre-seed, seed, or whatever name you want to give it. That would be the time to bring in outside capital so that you can actually get your service, your product into now a mass user hands. After that, and I'll kind of end it after this next point, after that is really once you start entering growth. So once you start entering growth, in my mind, I categorize that by being able to define conversion rates, retention rates, cost of user acquisition, cost per lead, all of these different metrics that you might hear, on TV shows, or when you think about a Series A investment, perhaps that's what it is. At that point, once you can readily identify and measure all of your different metrics, now you're ready to start optimizing those. So once you can kind of get to a point of, we figured it out, we're optimizing, we've built our engine and it's running, now it's time to pour gas into it. That's the next point where you really raise capital. Anything after that is I suppose, more supplemental. So then there's debt, there's Series B, C, D, E, F, G, and all other different types of liquidity solutions. But from my experience and what I've seen, it's kind of those initial first three stages that probably carry highest amount of risk, and more often than not, the most difficult to raise for.
Incredibly helpful opening salvo. We had a question from the audience about defining proof of concept, which I think you hit on in a lot more detail as you went. But Rosie, typically we define proof of concept as real adoption in the market. That you have a small initial cohort of real buyers who have said, "Yeah, this isn't just an idea. I want to use this. I see value in your solution. I'd like to try it out." And so there's not at least I've never seen a magic number of saying it's X number of clients or it's Y amount of revenue. It is saying that, well, this is no longer an idea. It's out in the market and we go. Coming off of that, I think really robust list of by stage, a lot of the reasons why companies should and when is the right time. Jeff Briggs, do you mind shedding some light on, first of all, if you have anything else to add, by all means, but what are some of the wrong reasons to raise capital that you've seen clients go into this and think that they needed to raise that was possibly misguided?
For sure. I've got a couple good examples of each, and I'm going to follow up a little bit on some of the things Jeffrey Fiddleman was saying in regards to proof of concept, because I'm definitely of the mind that the answer is typically, I'm going to assume that we're talking about early stage, first money in sort of things, just based on the poll. And just assume that once you take on some sort of like venture capital type funding, you're essentially fundraising till, in perpetuity after that. But, basically in terms of proof of concept, you want to make sure that you are raising money when it's more than just a conjecture. You want to eliminate as many of the questions as possible before you actually go to people for money. And there's a lot of different examples of that. So, one of them is, let's say that you have a product company. You basically want to make sure that, you have, as close as possible to knowing you're going to have orders for your product before you sink a bunch of money into manufacturing it, right? So what are some ways of going about that? One example from a company that I'm currently in the process of launching with some partners right now, without getting into much detail, it is a eco-friendly bike chain lubricant. So pretty basic kind of product. It's something that ultimately we want to try to get distributed into, major retailers, bike shops, sort of like the major distribution chains. It's not really something that's going to be sold online for the most part, but our initial launch was through Amazon so that we can have some user feedback to bring to the distributors and stuff like that we are going to present this product to. So, once we have that, we go to these distributors, we have some feedback, we get orders for, a whole lot more units than we're selling right now. That's the point in time where we would go, try to raise some money internally or from family offices to bring that product to market for real. So we can get it off the ground for something that, we can fund ourselves. But if we get picked up by a Walmart or a Target, that's going to require a whole lot of money. But we have some certainty that the stuff's going to get sold. So that's one way to do, proof of concept. If you're doing a software product, let's say it's a consumer SaaS product or something, one thing you can do is put together a semi-functional prototype that's going to cost you significantly less money to put together than actually building the software, and demo that with potential customers. Once you have some potential customers that, are committed to using the software, that's the time where you could go to actually raise the money to build it. One example with a current client of mine through Paro, it is a consumer software company. They've got a product that helps kids essentially do school. So it's not specific to tutoring or anything, but it helps people walk them through the process of how to do different types of assignments, basically gives them a lot of structure. So the thing is going to cost about $1 million to build. So instead of just blindly going out and raising $1 million from somebody, what they're doing is they're implementing the same process in a non-software way to get feedback on the product. So they're essentially doing it as a person-to-person consulting business to get feedback on the whole process. They have a wireframe of what the software will eventually look like, but they're able to do that without raising any money. Basically the person that developed the wireframe is someone that's going to be a partner in the business. They found a way to get the validation before raising the money. And that is just a whole lot easier than, coming up with a concept, raising a bunch of money, trying to implement it, and then realizing maybe this needs to change a little bit. And then it just puts you and that initial investor in a very contentious situation because they typically don't want things to change that much. So I don't know if that answers the question of when not to raise money, but essentially the answer is you want to have as much certainty as possible as to what you're going to do with the money and what that money is going to do for you.
Absolutely. I think it answers the question exceptionally well. To kind of keep things moving on, I know we had gone, even in the opening poll, contained a lot of jargon that a non-finance stakeholder could possibly be a little tripped up by. So Dan, do you mind just kind of keeping this rolling with your view on some of the pros and cons, or at least an overview of the different funding sources that are available, ideally to a younger direct-to-consumer company? And if you want to use Paro as an example, I think we've really taken advantage of every single one of those, say private equity. I think that could be a pretty useful analogy.
Yeah. I think a lot of the setup of when you're looking to position yourself for a capital raise is your goals need to be aligned with what your investors or your source of capital goals are. If we're talking a venture capital firm, they're looking to 100x their money potentially within a certain time frame. It's going to be a little bit different if you're looking at private equity or your debt or family and friends. Things are going to get a little bit more flexible as you work your way down to smaller investors. And it's really important that your goals and growth goals are aligned with that. Some other areas we've seen people be slightly misaligned is they have the wrong entity structure for the type of investor that they're trying to push themselves towards. They want to take a bunch of VC money and they're a two-person partnership. You usually need to be a C Corp, be able to issue equity easily if you're going to be lining up for investors like that. Some other things and some other pros and cons I would say is as you work your way down to a smaller dollar amount or just an individual versus a large institutional fund, you do have a lot more flexibility when you're talking to maybe a family office or an angel investor. There's someone that maybe you can bring on as an advisor with an addition of a little bit of money in exchange for capital. The structures become a lot more limited because the checks become larger and those people get to call the shots as you're working your way up the funding food chain. At least that's what we've seen in Paro.
And yeah, before we move on, hugely helpful, initial intro. Mr. Briggs, Mr. Fiddleman, anything to add in terms of kind of the pros and cons of different funding sources at this, generally early stage?
I think one of the most interesting positional changes, look, when you raise capital, when you are a CEO or a team of founders growing your business, you are the owners. You are the ones calling the shots. You don't have to answer to anyone. And that's probably been the way it's been for a while. And more likely than not, it is that way because you chose the life of an entrepreneur. The moment you bring on venture capital money or private equity money, not to necessarily say that you now have a boss, but you definitely have somebody to answer to. You will have monthly calls. You will have people grilling you over why you didn't hit KPIs. And the buck stops with you being the CEO, the COO, the management team, or whoever's out there listening to this. So keep in mind that when you do raise capital, and maybe this has less to do about the actual capital raise and more to do with what Dan was talking about, make sure you're aligned with your investor. Make sure you like them. That's not to say if somebody you don't like is willing to give you money not to take it. Money's money and you're trying to build a business. But at the end of the day, just keep in mind you are going to go into a relationship with this individual, regardless of, angel investor that might want to have too much to do with you and your business, to a VC that maybe will just cut you a check and never call you again. So that's just kind of something to keep in mind.
Absolutely. And really appreciate the questions coming from the audience. Matthew and Stephen, in terms of what sort of materials or VCs, how are we going to pique their interest, and Stephen, to, where can we start to identify the right type of investors? Promise we will certainly hit that over the next 35 minutes. But before we move on, Jeff Briggs, we had a question from the audience specifically around SAFEs, which is an acronym, Simple Agreements for Future Equity. Do you have a hot take on SAFEs, kind of their pros and cons, or just ultimately your experience with them in the market?
Yeah, I've got I guess a couple comments in that. For one, I actually have an article out there called The Pros and Cons of Convertible Debt, which a SAFE is just another acronym for convertible debt. I would say that people have gotten, smarter about using these as, time has gone on. First of all, if you don't know what this is, basically a SAFE or a convertible note, which is essentially the same thing, is it's almost like pre-equity usually, in the fact that investors put money into the company, and it's essentially a promise that the next time you raise money, those funds plus some interest attached to it will essentially buy what the next investor is buying at a discount. So usually this is a pretty good solution for the first money into the company. A lot of times when people are, first raising capital, it's their seed round or pre-seed round. Valuation and things like that are a lot of conjecture, and, because there's not real metrics to go off of most of the time and things like that. So this is a way of, one, getting money into the company with a deal that's going to be acceptable to both, the founder and the investors, but, also sort of punts the conversation on valuation down the road. So if things go really well and someone gives you a lot of money and it's super high valuation later, they're definitely going to be able to come in at a lower valuation than that. But it sort of also puts a floor on things too. Basically, the one thing that would be very important is a lot of times people do this by default. And if you're not going to, if there's a chance that you won't raise money again in the near future, this can sort of put things in limbo. Because, you typically want to have some clause in there that says, hey, if we don't raise money within 2 years, it doesn't just put the thing into default, but it automatically converts to equity at, probably a worse valuation than you would have liked. But, you want to make sure you have all those bases covered. I would say along those lines, I actually have a current client that I've been working with for about 8 years now, had an investment from, call it a startup accelerator, that ended up going defunct. And we have this convertible note on our balance sheet from 8 years ago that was supposed to convert 6 years ago, and we can't even talk to anybody at the firm. So if for some reason, like, we wanted to sell the company, it's going to be a huge pain at some point. So if all they had was a simple clause that said, hey, if nothing happens, it just automatically converts or something like that, we wouldn't be in this situation. So I would make sure that all the potential outcomes are covered in the agreement.
We could spend an hour talking about SAFE alone. I think that was a phenomenal high level or mid-level overview. Last piece before we turn the page into the actual process. What are VCs looking for? How do we identify? How do we go to market? I thought Jeff Fiddleman had a phenomenal point around one of the non-financial impacts of bringing on capital. You're giving up decision-making control. And from a private equity standpoint, you might be giving up control of the company as a whole. From a venture capital standpoint, at a minimum, right, there's board decision-making power. Open question to the group. Are there any other non-financial impacts of bringing on capital that you'd like to share with the group?
One thing
I've got one that's more, I'll let you go on, Dan.
Okay, so just thinking of different ways that you could be raising money and different ideas. that investors might have for you. In the venture capital world, it's very common after you were to raise a decent sized round, $5 million or greater, that you're talking to a bank about potentially raising some venture debt, some additional money, very non-dilutive capital that you can bring on as well. And there's a lot of red tape that comes with that, where you have to keep all of your money within a certain bank that could restrict your business depending on the industry that you're operating with. As your investors come on with you, they might say, you know what, it's time that you start using my favorite lawyer instead of the lawyer you've been using since day one. There's a lot of very strong recommendations that might come your way, and you're faced with some potentially difficult decisions around whether you take the investor's advice because they wrote you a check, or you kind of stick to your guns and what you think is best for your business. It's a whole lot more relationship management than you'd anticipate versus just the injection of capital, that's for sure.
So I'm going to go on with a little bit of this is a non-financial financial impact. But as you said, you kind of give up some decision-making power. Typically, the hard decision-making power that you're going to lose is when to sell the company and when you can raise more money. Usually the investors have essentially a veto right in regards to they have to sign off on any new money you're raising or any sort of acquisition deal. And using those two things, they can either push you to, one, sell earlier than you want to, or two, not sell when you want to sell. And I've seen both of these things happen. So one situation is, this was a SaaS company. They're in the education space. I had been working with them from, essentially the founding of the company up through taking some VC money and stuff like that. They got a pretty, high dollar investment offer from a family office that had never done software startups before. Typically, they were more in manufacturing and things like that. So they weren't used to sort of the typical timeline of how these sort of companies are run and the fact that you're going to have to keep raising more money. They just had never really been in this sort of space before. So even though the company was doing really well, they just kind of threw their hands up and were like, we need to get out of this, like any way we can. So the company was on a great growth path. They, grew 5x in the year 2020. Plenty of offers to keep, continuing to grow the company. They really had no intention of selling, but there was such a disagreement between this investor and the management team that they just threw their hands up and they got an offer to sell, which, on the outside looked like a great, opportunity for the founders, but they could have grown the company 10x from where they were. So they left a lot of money on the table because, people that didn't really understand what they were getting into, once they're there, you can't really get rid of them. So they essentially pushed them, to a decision that they wouldn't have made otherwise. Another thing that can happen is you could have a good outcome on the table. Let's say that, this wasn't going to be the next Facebook, but, you put together a company, you haven't raised that much money yet, and you could sell it for $10 million. If you have investors in there that only care about getting $1 billion deal or not, they could force you to pass up, a nice exit for you, the founder, because they would rather take a 1 in 10 chance of getting $1 billion than walking away with, 5 million. So those are two of the situations you got to make sure that you're really on the same page with whoever you bring in, because once they're there, they're there.
Absolutely. You make your bed and you're gonna have to sleep in it. And so thinking through these things ahead of time, certainly valuable for anyone considering this. Let's turn the page though and start talking about the process. Let's start with you, Jeff Fiddleman. When you are prepping a client to go to market, what's your checklist? What are you making sure that they have just from okay, are we even ready to kick off this process? And we can save hey, what's going to separate a good pitch from a great pitch as a next step?
Sure. That is a large question. Okay, so all right, we'll take it from the basics. What do you need to actually go out and raise capital? I think initially what you need to go out and raise capital are 3 pieces of collateral. It's your deck, your projections or financial model, and then a valuation analysis or a capital structure. How much are you asking for? How much are you giving up for that? And typically when I work with someone, regardless of early stage, idea on a napkin, pre-revenue company, all the way through even a Fortune 500, a little bit of a different approach, but similar in that we always create a deck first. And surprisingly enough, oftentimes when we go through the process of creating a deck, oftentimes when we hit either the solution slide or a business model slide, we'll have internal conflict between the CEO and the COO or the two founders of what does the business actually need to look like. So I always say it's much easier to build a business on paper and tear it up 5 times, 10 times, 20 times than actually build a product and then realize it doesn't work or you didn't think through it enough. So preparing to go out to a capital raise is a lot about creating a deck, creating a narrative. Why are you raising capital? What are you raising capital for? I love taking the KISS approach, and I won't say what the letters stand for. If nobody knows what it does, look it up. But I try to keep it as simple as possible, and in that, really trying to explain what is the problem that this company is trying to solve. What is the solution that this company is proposing? Again, whether it is a product or a service, I think from an organizational perspective, a lot of decks need to tell a story. And that story is supplemented by the founder who's actually making that presentation. And more often than not, when we do work with our clients, it's very collaborative, especially on the deck piece, because the most successful people that we've worked with, successful meaning they've gone on to raise capital through fundraising strategy, have ownership over that deck. So they actually worked on that deck. There was input from them. They know why every word is on every page and why the graphs are what they are, because they had a piece in that process. So when going in front of investors, there's an additional layer of confidence that that entrepreneur would have when going in front of them, as opposed to somebody just creating a deck and then taking that deck to present to someone else. Mm-hmm. So kind of going back to answer your question. So what are the things you need and how do I prepare somebody? It's a lot about the deck, the story, and the narrative. And how do we spin this story to go in front of investors? And it's really important for everyone on the call to understand that investors are paid to invest. They're not paid to say no. They're not paid to sit on capital. And I'm talking now more about people who run funds. But they're paid only when they actually allocate dollars into businesses. Now, they do need to say no, and your job is to convince them of why they should say yes. But ultimately, a lot of funds and fund managers are paid to invest capital. They're paid on carry, they're paid on performance, they're paid on all of these different metrics, not investing and not how much cash they have in the bank. So your job as an entrepreneur, kind of most importantly to keep in mind when walking in, is that they are incentivized to give you money. Help them write their investment memo to the risk committee that sheds your company in a good light. And having a founder at any stage, being confident about their business, understanding the main points of how the business works, and what this capital is going to be used for, to show the investor how they're going to be making money is most important. Financial modeling, that's also really important. Although that's majority of what we do, and not to make it less important, ultimately what a model is for is to help illustrate the vision of the founder and of the business financially into the future. The main parts that an investor is really looking at a model, especially the earlier stage you get, is does it make sense? Meaning, are you going to make $1 billion in a year from scratch? And number two is, can the founder walk me through the assumptions? So if you're presenting a financial model to me, I don't necessarily need to know how you input every single formula, but I do want to understand as an investor how you think about assumptions, how you think about growth, how you envision getting from where you are today using my capital and where you are tomorrow. And then finally, the last piece was that valuation analysis and capital structure. So we try to prepare our clients as much as possible with data. And to one degree that, where the market is today, and I'm happy to kind of talk more about the venture capital market, but it is a little bit of qualitative mixed with quantitative. And as much as I can help structure the story of the qualitative, why is my company worth X? I try to supplement that as much as possible with quantitative data on other comparable transactions that have happened in the market, and where we are seeing companies trade at now, so that you can go, again, you being the entrepreneur, confidently in front of an investor and say, we are raising at a 50 million valuation, or we are raising a safe note with a $10 million cap. And when asked why, you have the data to back up why. So I'll put a pin in it there.
And I just want to quickly recap for the audience, because there was so much value in that overview. A few things, in terms of your go-to-market packet, your valuation, which is going to roll up your historical financials, which needs to be accurate, right? How did we get here? Your move forward, your pro forma, that financial model Jeff spoke to. Where are we going with this? Quantify the vision, and then that pitch, that story to tie it all together. If you're going to market without any of those, you're not going to have a good time. And one other facet that I didn't want to get overlooked is the deployment of capital should really be a consistent thread through all three of those. You're asking them for capital, you damn well better have a very clear vision and a quantified vision of what you're going to do with it. Hopefully I didn't completely butcher the overview, Jeff, but
no, you're good.
To paraphrase. So maybe hand it over to Jeff Briggs. Build on that as a foundation. What are you seeing in the market that's going to separate, in let's say a VC's eyes, good from great? We talked about what the bare essentials are, but what are you seeing that's going to make this, higher degree of confidence, higher valuation, really get to the heart of what these investors are looking for?
For sure. So, I think a lot of the, check boxes in terms of, having your deck, having your model and all that kind of stuff, that is, obviously all stuff you need to have. But, kind of going along with what Jeff Fidelman said is you have to make sure that there's substance behind it all. And I think, going to some sort of non-financial considerations, the biggest thing that, assuming that everything is there that needs to be there, the biggest thing that I've seen that separates, successful fundraise ventures from, unsuccessful ones is you have to be able to explain why you were the person to do this and what would set you apart from other people in the market, whether that's a proprietary product or you have some specialized knowledge that, isn't easily, isn't easy to duplicate. You have to be able to have that explanation down. One thing I like to look at in terms of software companies is kind of this test. If, someone in Silicon Valley came out with, they're going to put $1 billion behind knocking you off, could they do it? And what I like to see is that a lot of times it's not necessarily in the product or the technology, but, the people behind it that are hard to duplicate. You couldn't just go like rehire these people to do something. One example is there's a company that we're involved with that has software for tracking clinical trial data. Well, every single person from salespeople to internal people have all worked in labs doing clinical trials, and they know exactly what they need to do. They know what the customer needs more than the customer knows. And being able to have some reason why you're the people to do this is extraordinarily valuable. Just one random example. Apparently lots of hospitals are, because of HIPAA reasons and stuff like that, they run like very old software and browsers. Whereas if you were just a software engineer that's like, I'm going to go duplicate this product, you're probably going to have it, all ready to go for all the newest technology and stuff, but it wouldn't work on their existing systems. You wouldn't know that unless you actually worked in that environment before. So, being able to explain why you're the person to do this, getting back to sort of the financial aspects, I want to make sure that, in terms of the assumptions, why are those assumptions right? Do you have validation that, just as like if you're using a cost of customer acquisition and you say for every $10 in ads, it's going to generate $20 in sales. Why do you know that? Have you done some testing with small dollar amounts? Have you run, $100 worth of test ads and that's what you're basing it off of? Basically, anything that is hard facts behind the assumptions you're using is going to push you far ahead. One of the primary mistakes I've seen in regards to people trying to do things like this in, assumptions and models is, okay, so we currently have one salesperson, and that salesperson's selling $250,000 of software a quarter. So we're going to hire 4 more, and that's going to add $1 million a quarter in sales. Now, unless you have a very clear reason why you're missing all these other leads with your one software salesman, just scaling personnel and stuff like that, there's really no reason why that's going to directly lead to more sales. So you have to say why more people will help. Maybe you're getting the entire market with the one person you have. So like, how do you know that those assumptions you're using are valid, and that when you scale them, it's actually going to scale what you think it's going to scale and not just extra cost?
Yeah, and I think so many parallels, whether they're software founders, and I know there are a lot of, direct to consumer founders in the line as well. Parallels to everything that Jeff Briggs was mentioning here, in terms of your unique why, whether it's supply chain, whether it's passion, whether it's understanding a market, as well as the scalability and defensibility of assumptions, ubiquitous across business models. Pushing this forward, maybe one more stage in the fundraising process. Jeff Fiddleman, how do you think about identifying the right now? Let's take it as a foregone assumption. Well, we want to go raise from a family office, or we want to go raise venture capital. How do you start thinking about the right investor, the best investor for a given business? And Stephen Scott from the audience had a specific question around, are there online networks? You mentioned Startup Grind in particular, or are you looking to other sources to really hone in on, the right end for this roadshow?
That is a good question, and as you can imagine, is asked by everyone that we work with, and probably Jeff Briggs to you, and Dan, John, even I'm sure to you in
Sure.
kind of onboarding. So ultimately, it's a game of numbers. And I'll say that as a more or less blanket and very general statement. Yes, you can network. Yes, introductions are the best way of raising capital. So let me not misstate the importance of having a warm introduction, however that may look like, whether it's I met someone at a bar, this is a secondary connection through LinkedIn, you met someone at church or synagogue, or anything in between at the bagel store. When you're a founder raising capital, this is the only thing you're thinking about, and everyone is a target. So again, obviously the later stage capital, you don't necessarily go to a bagel shop to raise capital, but the point I'm making still stands, is that this is your full-time job. This is all you need to think about. And we work with a lot of people that sometimes don't necessarily like asking for money or don't want to be pushy about it. Look, modesty is a fantastic trait, not when you're capital raising. You want to put that away, and you're raising for your business. You're raising for the survival of your business, for your employees, for your product, for your service. That's what you need to be focused on. Now, where do you actually go to find those that you might not have a warm introduction to? So I'll give you the typical answer that probably anybody in my situation would give: networking events, coffee events, go on Eventbrite, go on LinkedIn, go on all the groups you can possibly find, and become active. So I say that as a caveat, in that you don't just want to put your name in all of these different groups and then leave them idle, but maybe choose the top 5, top 10, whatever your capacity or bandwidth will allow you to. Choose the number of groups or the number of networking events where you can attend and be very present. Being present will give you the visibility that you need, whether it's to your target investors or maybe to those investors that are secondary or tertiary, that are in the room, that are paying attention, and maybe you're not targeting them. So aside kind of from that typical answer, also what we often do is, for example, go into PitchBook and try to pull a list of investors based on their activity in the market, based on current check sizes, demographics, geographic interests, So getting access to lists of that nature is extremely helpful, which brings me back to the initial point of this is a game of numbers. Again, anybody on this call is probably on Twitter, is probably on Instagram, has probably seen that XYZ founder went to 55, 100, 1,000 different meetings, and it took one investor to be that anchor and pile in. And there's a saying in venture capital that nobody wants to be first, everyone wants to be second, and it's really true. That's just how VCs operate. So it is a game of numbers. It is get 50 rejections, get 100 rejections. If you believe enough in your product and you're out there for long enough, somebody will believe in you and invest in your business. So don't be discouraged. It is a game of numbers. Do everything else I said as well, but don't think just because you tapped your network that you'll raise the money. Keep doing it until there's cash in the bank. So imperfect answer, game of numbers is ultimately what I recommend above and beyond what is out there in the internet, but it really does work.
Absolutely. Just as it's such an important topic, I only have 10 minutes left, but Jeff, anything to add to that piece in terms of investor identification? I know I've personally seen from the venture capital space, it's got to be a numbers game. Sometimes when we talk more about family offices that, invaluable Rolodex of an experienced CFO can really come into play of just knowing where to tap. But anything on that topic of investor identification you want to add?
Yeah, I think, kind of following on to the point of the numbers game, part of it too is, most people that are doing this don't have a network. And, the question is, if I don't have a network, how can I go, raise money from people if I don't have any warm intros? Well, you actually can create some of your own warm intros just by being around the right people and finding the places to go. So just about, every even mid-sized city in the US has some sort of, nexus for startups and funding and stuff like that. So one example, in Cleveland, Ohio, there's a quasi public-private organization called Jumpstart. They have a venture capital seed fund that, has some money from private investors, some from the state of Ohio, and they put on tons of events. They've invested in a ton of different companies. Going to those different events, you're going to meet people, the people that are like the, local angel funds and angel investors and stuff like that. They go to those things too, to find, new companies. And, just by being around, you're going to create your own network. The other thing as well is, I think one of the most, successful ways I've seen people sort of break into that little, network in their town is going and finding a, early stage startup that is backed by several local investors. And it might not be a job you want forever, but go work for them in some capacity and start talking to the CEO and stuff like that. I'm thinking companies that maybe they have like 10 or 20 people and, there's a lot of mobility inside the company. That's a way to get you noticed by some of the local investors, And one of the things I've seen is that a lot of times, if you're very upfront and saying, hey, I eventually want to go launch my own company. The CEO of the company you're working for very likely is going to help you out. Most people that are in this space are not, entirely, in it. Well, if you're going to do that, then, don't come work for me. And if they are, you don't want to work for them anyway. But sort of putting yourself in the situation to where you can meet people, I think is one of the most important things. And, if you just start like Googling, I'm looking for fintech VCs and cold calling people, that's probably not going to work that well. But there's definitely a middle ground between already having a network of people you can tap and starting from scratch with nobody that you're really connected to. You can make some of those connections if you're intentional about it. It'll probably take some time. It may take a year or two, of just going around to these things, but the odds are you'll eventually meet people. So I think creating some of your own warm introductions is, a way to go about it if you don't already have a network.
And how about that for some, I think, unexpected words of wisdom on a capital fundraising call? So much about network and putting yourself in position to make those connections. It's not all serendipity. You can control a lot of this.
Mm-hmm.
Dan, I actually want to lean on you for the last formal question before we maybe go around the horn with 60 seconds of parting words of wisdom. Question from the audience from Kevin Flores about additional resources VC or other capital providers can offer. What's been your experience with beyond the capital? How are you weighing some of those additional value adds that the right investor can offer?
Fantastic question. Kind of dovetails nice to what we were just discussing about networks, and to add on a little bit there, highly recommend getting an advisor or a mentor that comes from the space you're trying to disrupt, and try and find some way to incentivize them to help you. Helped Paro a ton early on, giving a tiny bit of equity to some formal advisors of the company, led to our first investor intros, which led to our next investor intros. Very invaluable bet we made early on that wasn't a very high stakes bet, but really changed the course of the company there. To formally answer the question around what other value adds are you looking at in an investor, I think you need to identify, again, what your goals with the investor you're looking at. If you're building a SaaS company and you're based out of the Midwest, you might want to look to the West Coast. That's where a lot of the tech, at least historically, and those investors have come from. If you're someone who wants to pride yourself off of being a great steward of capital and having some really good early metrics, West Coast isn't going to care too much about those. They're prioritizing growth and top line over everything. But maybe the Midwest, you'll find an investor that appreciates that a little bit more, what you might call just more intention behind your growth versus a land grab trying to grow as quickly as you can. What I've seen is value add from the investors that we've brought on is who else, what other LPs sit on the actual board of the company that's investing from you? Are they in any areas that you're trying to get into? Maybe you're in a space that's very highly regulated. Does your investor have any ties maybe with Capitol Hill that can really help you have an insight into upcoming laws and things that could be impacting your business? If it comes off of, you know what, I have a very rounded out board right now, but the one thing I'm missing is someone to push us on the product end. How can you find an investor that prioritizes SaaS investments over everything else? That's something you're going to want to need to round out your board. Other additional things that have come up for help. We have a lot of quarterly requirements that come from these investors, just purely on some red tape reporting. And I found that even the heads of finance at those companies that are requesting those can be super accommodating and helping you with day-to-day type things for how do I know when to make the next move on an ERP system? How do I know when I need to beef up my reporting and look towards my next audit? Things like that. Overall, I can't say I've had a bad experience with any of the lead investors we've brought on. Our strategy has really been about how do we round out our board and make sure we have an even balance of opinions so we're not being pushed into one direction over another.
A lot of nuggets in there, and I'm glad this was recorded because there's going to provide a whole lot of value moving forward. We got a few minutes left, so in 60 seconds or less, let's take this alphabetical, starting with Mr. Briggs. What's the one piece of advice, whether a pitfall you fell into that you wouldn't do in hindsight, or just words of wisdom for the audience that you want to leave everyone with?
Okay, so two things. One would be, and I'm assuming this is like the first time you're raising money for this particular company. Before you sell equity, exhaust every possible way of bringing in dollars before you do that. That could be from pre-selling your product. It could be from, working with somebody that's gonna, do work for you for equity instead of, paying them a lot of money. Exhaust every path you have before you really need to go sell the equity. And number two is, going back to talking about, what are the best value adds that various investors could have. I would say the most important thing there is make sure that your investors are not going to be a distraction or a value losing proposition in terms of, running your company. So, I've seen investors be a value add, but I've seen a lot more be value subtracting. So try to get his best to take on that before you break someone up.
It's not all positive. Mr. Fiddleman, take us home.
Okay, fine. This is hard. This is hard, guys. If it was easy, everybody would do it and everybody would do it successfully. I can tell you, coming out of VC, starting my own business was the best and worst decision all at once. I probably didn't choose the timing so well, just having gotten back from my honeymoon. I left VC and I said, I'm going to do my own thing. And I think that first year, net or gross, however you want to count it, total, maybe I made $3,000. And it was hard, and it continued to be hard, and it is still hard. Even now, it's different types of problems and different types of headaches, but it's still really, really hard. So the reason I say that is that this is a journey that you collectively, the people here, have chosen to go on. Maybe lonely, maybe not. The point is that it's hard. Don't be discouraged. Keep at it. And that's the most successful people that I've ever seen and met and read about, are people that have continued through and persevered during the times of difficulty. Never be afraid to kind of cut the cord when you think it's not a good fit, whether it's an employee or a business decision or a business model or service or product. But if your commitment is behind whatever business you are founding, whatever business you are running, you will be successful. But it is hard.
Can't end with a better message than that. Jeff and Dan, thanks so much for the time. Megan, thanks as always for giving us a platform to host. Hope that we added a considerable amount of value. I don't know if there's anything else you want to wrap with before we let everybody continue with their Wednesday.
Well, thank you guys so much. As John mentioned, we recorded this. We'll be sharing the recording with everybody. You can rewatch it, take notes, use this as a resource to keep coming back to as you guys are building your businesses. We are right at time, so I'll follow up with an email with the link to the recording and some updates on our upcoming events. Thank you guys so much for sharing all of your amazing insights today.
And thanks to the audience. Ton of great Q&A. Makes this a whole lot more fun.
Yes.
Yeah,
thank
thanks
you,
everyone for
everybody.
joining.
Enjoy the rest of your week.
Thanks, everyone.
All right. Have a good one.
Thanks.